The latest Oxford Economics Economic Insight Report for the Middle East, commissioned by ICAEW, reveals a positive regional outlook despite the darkening global landscape. And we're joined by ICAEW Economic Advisor and Chief Economist and MD at Oxford Economics, Scott Livermore. Thanks so much for joining us today, Scott. Now, you forecast Middle East GDP growth at 5.2% this year. That's an increase of 1 percentage point on your forecast from just 3 months ago. To what do you really attribute this growth?
Right. I think the core reason is the oil sector. We're going to see a significant increase in oil production in the GCC this year. If we follow the OPEC plus production quotas, most countries in the region could see double-digit production growth, and that translates directly into quite a significant boost to GDP. But more than that, with oil prices well above $100 per barrel, we expect oil prices to average $112 per barrel this year, which would be the highest annual average on record. This is really an oil windfall for the governments of the region and enables the governments to support the economies by implementing growth and diversification agendas. And that's really driving the non-oil economy along as well.
Okay, let's get to those GDP numbers in just a moment. But first, I want to ask you about the rise in oil prices, how they've supported Gulf economies. But in a scenario in which several large economies slide into recession, will it weigh on oil demand and will it test the GCC's resilience?
Yeah, I think you highlight the big risk for the region there. If oil prices plummet, then the region is vulnerable. And clearly a factor that could tip oil prices into a negative scenario is a recession elsewhere. And perhaps a China recession is more to be feared than a European recession, given the importance of oil demand. And that could lead to a squeeze. But I think it's important to remember that the current level of oil prices is still a long way above the fiscal break-even level. So the level of oil prices countries around the region need in order to have a budget balance. So there is some fiscal headroom to play with. The countries of the region implemented fiscal consolidation and they haven't really rode back on that with the high oil price. So there is some buffer, but a fall in the oil price is a significant risk, especially for the likes of Oman and Bahrain. I think probably the likes of Saudi and UAE have enough reserve to stay the course, but nevertheless, it would still be a headwind.
Okay, and sticking with Saudi and the UAE, you forecast 7.1% GDP growth for Saudi and 6.7% GDP growth for the UAE. But you say their budget surpluses won't really boost spending as they'll be used to pay down debt. By how much do you expect these debt to GDP ratios to decline across the GCC, and what impact will that have on economies here?
Right. I think the easy thing to say is there's going to be a significant strengthening of net financial positions across the GCC. We saw in Oman, and I know you didn't mention Oman, but Oman saw its first credit rating upgrade since 2007, and that's going to be a really important boost. I think how it impacts debt across the region will be varied. You'd expect Bahrain and Oman to reduce debt given the opportunity. In Kuwait, you're likely to see the General Reserve Fund build up. And in Saudi, for example, the Ministry of Finance has already said that the surplus revenues are already going to be allocated to the National Development Fund, Public Investment Fund. So in these countries, it's really about solidifying and strengthening the financial base in order to help the countries achieve their visions and their diversification goals. And if the financial markets, if the capital markets are ripe for further debt issuance, then it would not surprise me if some of these countries, even the UAE and Saudi, issue further debt, as we are seeing at the federal level in the UAE, where there's been a recent debt issuance.
Absolutely. And you also forecast non-oil GCC GDP growth at about 4% for 2022, and that's up from your previous forecast of 3.4% just a few months ago. How are these economies minimizing the impact of global headwinds on business activity to really continue expansion?
So we've got a number of one-off factors in the region, whether it's Expo 2020, whether it's the FIFA Football World Cup in Qatar, which boost activity. We talked about earlier about the government's role in driving growth, and that's really been enhanced and boosted in recent months and provides a strong fiscal stimulus. But it's more than the fiscal injection. The reform agenda is clearly attracting foreign capital to the region, boosting the real estate sector. And we've seen a strong rebound in the travel and tourism sector as the region as a whole has dealt relatively well with the COVID crisis and has come out fairly strong. And we expect to see continued strong growth from the travel and tourism sector.
Okay, now ICAEW predicts GCC inflation to average about 3.1% this year and 2.5% for 2023. The GCC doesn't really have the high inflation seen in the US, but central banks here are obviously implementing the same interest rate hikes. Will the rise in the financing costs dampen the non-oil recovery of next year?
Yeah, I think it's absolutely a factor behind the slowdown in growth that we're forecasting for 2023, as higher rates dampen domestic and foreign demand. I think the GCC and the state of the economies, given the growth outlook, given inflation, needs higher interest rates, but probably not rising as fast as the Fed is likely to implement over the next 6 months. And what we're likely to see is that the governments of the region continue to support the economy. Recently, we saw the UAE increase fiscal spending at the federal level, and that should serve as a boost and an insurance to keep growth higher than otherwise it may have been.
Thanks so much for joining us and for your insights. Scott Livermore, ICAEW Economic Advisor and Chief Economist and MD at Oxford Economics.